Wonderful today. It's your friend Jerry here, Fly Credit Solutions, the place to repair and rebuild your credit so that you can get your houses, finance your cars, and get financially elevated. We teach you how to build your credit, repair your credit, and leverage your credit so that you can save more money, make more money, and leverage other people's money. So today we're going to be talking about interest rates. It's a really big thing that you need to know when you're managing other people's money, aka your credit. So we get a lot of questions regarding interest rates, right? How do the interest rates work? Am I getting charged too much? What interest rate is right? What should I be going for? Well, we're going to be answering all of those questions today so that you can gain some clarity around what an interest rate is, so that not only will you know how much you're paying out in interest, but you'll also know how you can save money on the back end with interest too, right? Because most banks want you to pay as much money as you possibly can for borrowing their money. But today I want to teach you how you can avoid that altogether, how you can actually decrease or even eliminate a lot of the interest payments that you're making on your credit cards, your loans, student loans, mortgages, anything that you're really paying on to another company or a bank. So I'm really excited to give you all this information today. It's going to be a lot to really get your mind around. We're going to be doing a lot of math exercises just to sharpen your skills, of course. So take out a pen, take some notes, get some paper, invite a friend, because this is truly going to change just your perspective about lending or borrowing money, period, and paying that money back. So let's get started. All right, so the first thing that you guys are going to want to know is what is an interest rate. So quite frankly, just point blank period, the interest rate is the cost of using other people's money. So this could be the bank, of course, whenever you take out a loan, or if you open up a credit card, they charge you interest on that. Right now with credit cards, it's a little differently, because if you don't use them, then you're not paying any interest. But with loans, mortgages, student loans, personal loans, those type of accounts, which are installments, you're going to be paying interest on that month after month after month, and the interest is already calculated into the loan. So we're going to talk about the difference between those two so that you can understand how it all works. Now there's two different types of interest. There's simple interest, which is calculated daily, and billed monthly. So these are your credit cards. These are your Citi, your Chase, your Amex. These are the credit cards that you have open. Whereas with simple interest, the thing is, banks don't know when you're going to pay the balance back. It's very different from an installment loan. An installment loan, you're charged amortized interest, which is front loaded into the loan. And the reason being is because the bank knows when you're going to pay the loan off. They know that you're going to pay it off eventually. So because they know that, they want to make sure that they get their money up front first. They want to get the interest payments out of the way, and then you'll start working on the principal balance, which is unfortunate, but there's a way to actually get around that. So we've actually talked about that in previous webinars. If you haven't caught that, I would definitely encourage you to check out our Fly Credit University, because our Fly Credit University actually teaches you how you can leverage amortized interest and how you actually can pay that stuff off so that you can minimize your interest payments on those type of loans. But long story short, simple interest is calculated daily, billed monthly, like your credit cards. Amortized interest is what you're going to see on your mortgage loans, car loans, student loans. Okay, so let's actually talk about how that all works. So let's say that you have a credit card. Now the credit card is accruing daily interest, right? Let's say that the interest rate that you have on your credit card is 23.99. Now what you need to know about the 23.99 is that's an annual percentage rate. So if you carried a $700 balance all year, you would have accrued 23.99% on that balance for that year. But it doesn't really work that way with credit cards, because there's a likelihood that you're going to pay the balance in full, right? Because this is what we teach. We teach you to pay your credit card balances off in full each and every month so that you don't have to pay any part of that 23.99%. But let's kind of break down the 23.99% so you can understand how you're actually billed, how the credit card companies bill you for the charges that you make on credit cards. Now, because the interest is billed to you daily well, it's calculated daily and billed monthly, you have to break the interest down on a daily basis. So what you'll do is you'll take that 23.99% and you'll divide that by 365 days, which will give you about 6.5% overall on a daily basis. Okay, so let's say that you carry a balance of $700 for 31 days in that month, right? So you'll take $700 that you're carrying in that month, that 31 days in that month, and then you'll multiply it again by that daily interest rate. And what you'll get is you'll be charged $14.26 on that $700 balance that you carried for that 31-day period. So as you can see, the interest on your credit cards, they're really not that bad, but you have to make sure that you're just not carrying high balances on your credit cards. You just have to make sure that you pay them off each and every month, or you make consistent payments on your credit cards. Most people don't just carry just a $700 balance on their credit card each and every month. Well, some people do, but for the most part, you're using it, you're paying it off, you're using it, you're paying it off. So the average daily balance on your credit card is going to be different, which is the way you're actually billed on your credit cards because of that reason. Because you use your credit cards day in and day out, you pay them this day and then you run them again and then you pay them another day. What the credit card companies do is they charge you an average fee on that daily balance. So whatever your average daily balance is going to be what they charge you interest on. So if you charge your card $700 1 week and then you pay it off, or you charge it up to $1,400 a week and then you pay it off. But if you're carrying balances, you have to find the average balance that you're carrying all month, and then you multiply that by the 6.5% so that you can actually get your actual payments or the interest that you're going to accrue for that month. But just to keep it simple, that's the example that we wanted to use. Now, because you know that the interest on your credit card is calculated daily, there's a couple of things that you need to know to reduce the payments on your credit cards. The first thing, of course, is to pay the statement balance in full each and every month. The reason why you want to do that is because of actually step 3, which is the grace. You want to take advantage of the grace period benefits. Now, with grace period benefits, the way this works is you don't get charged interest the day you make the charge on the credit card. You actually pay for the charges that you make on your credit card a month after. So that following statement balance, that you carry that following month. So if you carry a balance in June, you're going to pay interest on that in July. So it's really important that if you want to eliminate any interest payments, period, pay it off before the statement is due, the statement balance is even closing out. And then, so if that's the case, then you can take advantage of the grace period. So you can actually look at your credit card statement or your credit card terms and conditions to find out what your grace period is on your credit card. But there's a grace period where when you charge the credit card to when they actually start charging you interest on that charge. So you have a little window where you don't get charged interest on it. So you can take advantage of it if you're not carrying balances on your credit cards. But if you're carrying balances month after month after month, then you won't be able to take advantage of that. So keep your average daily balance as low as you possibly can if you're not going to pay your statement balance in full each and every month. So if you're going to do anything, keep your statement balance between 0 and 9% of your overall credit limit. So if you have a $1,000 credit limit credit card, then keep the balance on it between 0 and $100 a month. That way, not only will you be able to minimize the interest rate payments that you're making on the credit card, but it will be really, really, really low. So those are really 3 main tips that I want you guys to take away when it comes to those interest rates and minimizing the interest rate payments that you're paying on your credit cards. Now, how is that different from amortized interest? Well, before we get into that, I actually wanted to talk to you all kind of break down how your car loans work. So we always see these offers on the TV, or we always see these offers everywhere that tell us that you can get a car loan, which is actually an amortized loan. You can get a car loan for 0% interest. You've seen those offers, right? But the thing is, there's some things that dealers don't tell you about those offers. So let's talk about that. Now let's say that you want to buy a car. Now I know this isn't the prettiest car ever, but let's just say that you want to buy a car. Now this car has 0% financing over 72 months. But as you can see, there's a little asterisk there that says, oh, there's a special note. You need to read the fine print. And the fine print says you could either get 0% financing over 72 months, or you can get a $5,000 cash purchase discount. So what that means is if the car is $25,000, they're going to take $5,000 off of that of that total purchase price if you pay for the car in cash. Now most people don't have $20,000 laying around. So there's a caveat, there's a little obstacle that most people don't want to overcome, because they look at it and they say, well, I don't have $20,000, so I'll just take the 0% financing over the 72 months. Well, let's kind of understand how that actually doesn't work out in your benefit. So let's say that you get a $25,000 loan for this car, just so that you can get the 0% financing on this particular vehicle. So you've got a $25,000 loan, there's 0% interest on the loan, and you're going to be paying it over 72 months. So just basic math, it's $25,000 over 72 months. You're going to pay $347.22 a month over those 72 months, which is going to equal $25,000, which is the total cost of the car. But let's say that you took the cash purchase discount. Let's say that you say, you know what, I want a $5,000 discount on this car. Now you may not have $20,000 laying around. Well, if you're wondering how I got the $20,000 number, you're going to take the $25,000 purchase price and you're going to subtract the $5,000 cash purchase discount. And you're going to have to bring $20,000 to the table. This is the only way that this deal is going to work. So what you could do is you could go get the loan, a $20,000 loan from your bank, your credit union, just a financial institution that you already work with that can actually give you the $20,000 loan. But the thing is, you have to figure out how much interest you need, well, the maximum amount of interest that you'll have to pay in order to keep that total below that $25,000, well, actually $20,000 threshold, because you don't want to pay more than $20,000, right? That's the whole purpose of you taking the discount, is because you don't want to pay over $20,000. So you're going to take out a $20,000 loan, but you have to figure out how much interest you're going to have to pay on that loan over that 72 months in order to pay the same exact monthly payment. So if you want to make the same exact monthly payment of $347.22 a month on a $20,000 loan, you'd have to pay 7.64% in interest. Okay, so if you had a $20,000 loan over 72 months and you paid 7.64% on that loan, you would end up paying $20,000 on that loan total. Okay, so it's still a good deal, right? So you still get the $5,000 off the overall $25,000 price. So you only end up spending $20,000 on the car total if you decided to just take the discount versus the 0% interest. Now, let's kind of understand how that loan amortization schedule works with these kind of loans, okay? Because yes, you could save a lot of money just on the cash purchase discount versus the 0% interest rates. But what if you could save even more money? Sure, you have to have the 7.64 interest in order to pay $20,000 total on the car. But what if you could pay less than that? What if you could pay less than the $20,000? Well, let's say that you got a $20,000 loan for 4% APR. And you can actually do this if you have some relatively good credit. If you have some relatively good credit and you're looking for a newer car anyway, you're going to get a pretty low interest rate the newer the car is. The older your car is that you're going to finance, the higher your interest rate is going to be. Why is that? Because it's a risky, lending decision for the bank. More than likely, if you're borrowing money for an older car, the car might break down. It's a risky investment for the bank. So they tack on a lot of interest in order to cover that type of I don't even know the word I'm looking for right now, but they use that front loaded amortization schedule to get as much money back in interest, and then you can start paying on the principal in the meantime later on in the loan. And I'll break that down in the next couple of slides so that you can see how that all works. But if you had a $20,000 loan that was amortized at 4%, okay, if you had a 4% APR on a $20,000 loan, your payments over a 72-month time span will be $312.90. It's very different from the $347.22 a month, right? It's actually cheaper. So if you had 4% interest, you'd actually pay $312.90 over 72 months, and you'd only pay $2,500 in interest. So you'd only pay $22,529 just to pay off the car total at 4%. That's cheaper than the 25%, right? But the thing is, what if you could just go back and pay the $347 on this 4% car loan? You'd be able to pay this balance off so much faster, and you'd have to pay a lot less in interest payments because you're paying more on the loan. When you pay more on your loan, the same amount still applies to your interest, but more will apply to your principal, so your loan will be able to get paid off a lot faster, which is the reason why I tell people, try to get the interest rate as low as you possibly can, even if you can afford a higher interest rate. It doesn't matter if you can afford a high interest rate. You still want to get the lowest percentage that you possibly can get so that you can pay off the debt faster. Because if you have more money to spend on it anyway, use that money to pay the loan off even faster. And you can definitely do that using a strategy. So you have a $2,400 savings altogether just by going with a 4% loan or using the discount. So if you got the $5,000 discount and you got that interest rate on that $20,000 loan from your bank at 4%, you'd save $2,400 on that loan total. That's awesome. You can even save even more if you pay more on the loan. So I want to just leave you guys with a little food for thought for now. I want you to avoid carrying balances on your credit cards. Another thing, you need to read all the fine print on your credit cards and on your loans. Okay, your credit cards, those terms and conditions, they have everything that you need to know about late payments, grace periods, how much money they're going to charge you for APR. Even if you pay late, they'll even raise your APR. So these are things that you guys really, really need to know. So take out your terms and conditions on your credit cards and read it. Also, amortization schedules are actually attached to your auto loans, mortgage loans, any loan that you take out. Banks give you a copy of your amortization schedule. You need to take a look at that to make sure that you're not paying more money in interest than you are in principal. And most people are, especially when they're borrowing with really crazy high interest rates. So try to avoid the crazy high interest rates, especially over 7%. If you can get anything 7% and below, you're in a really good place. You're going to save a lot of money on your loan. Do the calculations first, meaning don't go anywhere shopping for any loan or any credit card without knowing what your credit is. When you know what your credit is, then you can actually go online. There are plenty of financial calculators that are available that can help you do the calculation so you can figure out how much car or how much house you can actually afford. Okay, there's no reason to be shopping for $30,000, $40,000, $50,000 vehicles if you can't really afford that. So do the calculations first. Find out how much you're willing to spend on a vehicle. What I always tell people is keep your monthly payments on your vehicle between 10 to 15% of your monthly income. So if you make $3,000 a month, your car payment or your car expenses between car payment and insurance shouldn't be more than $300. If you're spending more than 10 to 15% of your income on a car, just car payments and insurance, you're spending way too much money. So do the calculations first, find out how much you make, how much you can afford, how much you're willing to spend, and then you can figure out what type of loans you should be shopping for. The loan shopping process is something that you should have control over. You should not give that control to banks, because if you do, you won't get the good end of the stick. So do your research first. And then the fourth point, of course, is optimize your credit scores. The better your credit scores, of course, the more money you're going to save. And speaking of saving money, let's talk about the amortization schedule in a little more detail so you'll know how this works. Now, we've talked about this amortization schedule in our previous webinar. So check that out in our Fly Credit University, and you'll be able to see how all this works so that you can actually leverage your credit to pay off these amortized loans significantly faster. It's ridiculous how you can use your credit cards, how you can use lines of credit as weapons to actually eliminate your debt faster. You can use other people's money to pay off other people's money a whole lot faster, twice as fast, 3 times as fast. But it's amazing. So you should definitely check out that webinar in our Fly Credit University. So in this amortization scale, you have a $20,000 loan at 4% APR. So we've talked about this already, where your monthly payment is going to be $312.90. You're going to pay a total of $2,500 in total interest payments. Now, as you can see, as this graph is, the way it's laid out is the first column is your payments, how many payments you're making. So you have the first payment, second payment, third payment, and it's going to go all the way up to your 72-month payment. So this is just the first 12 months of your schedule. So the first year of your payment that you're making on your loan, as you can see, you're making $312.90 on you're making those payments on your loan. But look at the principal and the interest columns. Okay, at a 4% interest rate, you're actually paying more towards your principal than interest. You're paying $246.23 for your first payment towards the principal and $66.67 towards the interest. So the principal means that it's actually paying off the balance on the loan that you actually took out, and the interest is, the cost of borrowing that $20,000. So the first year, as you can see, you're paying down the principal, and the principal is actually, reducing over time, and the interest payments are decreasing. So that's a wonderful place to be, right? So as the time goes on, you'll see that you're paying more and more towards your principal and less towards your interest. But what if you don't have really good credit and you're going out shopping for car loans? So this is the same $20,000 loan at a 24% interest rate. At a 24% interest rate at 72 months, and you're paying $526.54 a month over 72 months. And not only that, you've paid almost $18,000 in interest total across the loan at 24% interest. So as you can look at the amortization schedule again, you'll see that you're making $526 a month payment towards this loan. $126 is going towards the principal, and $400 has gone towards the interest. More money you're paying in interest than you are on the principal. So this is the reason why it's so important not only to shop around, but it's really important to get your credit together. Get your credit right before you go shopping for loans, because you'll be paying a ridiculous amount in interest. You'll be paying off car loans, mortgages twice over, 3 times over before you even pay off the principal balance on the loan. So get your credit right, guys. Get your credit together. Schedule a consultation with us if you need to, and we'll walk you through those steps so that you can maximize and optimize your credit score, so that you can get lower interest payments, so that you can pay off your debt a lot faster, and you can position yourself to be in a better situation down the line should you need to borrow any money. Okay, so But at 24% interest, just scratch it. Don't take out any loans at 24% interest. Don't go into car dealerships and ask them for loans, because what they'll do is they'll run your information through every database, and then they'll just hand you the loan that works for you based on the monthly payment that you said that you made, that you wanted to make. So pay very, very attention to the interest rates. I know I went on a soapbox right there, but these interest rates kill us. They kill us softly by taking our money, and you look up and you realize you've paid on these loans forever and you haven't even paid off even the balance of the loan. So I want you guys to be great. So take that and keep that in the back of your head so that you'll keep that in mind whenever you go shopping again for any loans. So if you guys have any questions about any of the information that we've covered today, I would really love to hear your feedback. Drop some comments below so that we can actually talk about interest rates. I would love to know, what are your particular questions about interest rates? Have you had problems with your interest rates? Have you realized, oh my God, I've spent crazy amount of money on this car, and if I would have gotten it at a lower interest rate, if I would have optimized my credit scores, I would have been able to get this much cheaper. I would have been able to save more money. I would have been in a better position. So if you guys have any questions, feel free to drop us a line at contact@flycredit.com, or you can schedule a free consultation at flycredit.com/consultation, and you can schedule a personal credit consultation with us. That's for free, and we'll walk you through everything that you need to know so that you can get on your way to have better credit. Now, not only that, we also offer a free Fly Credit University. So for $1, you can actually get involved and to learn everything that you need to know about your credit. We want you to get involved. We want you to get educated. We want you to get elevated. So you're going to learn not only about interest rates, but you're going to learn how to skyrocket your credit score over 100 points in less than 30 days. We're going to teach you how to pay off loans in a fraction, half, a third of the time that most banks think that you're going to pay it off. We're going to teach you how to pay off your auto loans, your mortgages. We're going to teach you how to leverage other people's money so that you can make even more money, so that you can travel more, you can save more, and have a whole lot of fun doing it. So check us out, flycreditu.com/free university. Sign up for $1 and you'll get the scoop on everything that we have to offer. But again, this is our Fly Credit weekly webinar. If you sign up for our Fly Credit University or our free Flawless Credit Guide, then you'll get all the notifications, and you'll know when we go live and what topic we're going to be talking about. So I look forward to seeing you all on the next webinar that we're going to be talking about next week, Wednesdays, 7 o'clock Central Standard Time. But again, I love sharing this information with you all. If you have any questions, drop them below, and we'll see you next time. Have a great one. Bye-bye.